Hello, and thank you for joining this webinar. I'm Tim Lindsay, Head of Manager Research at Klingenstein Fields Advisors. We're going to be discussing real estate today, so I'm pleased to be joined by three real estate experts from Timberlane Partners, a firm to which we allocate client capital. Before I introduce our guests, let me note we're going to have a Q&A session later. I invite you to send your questions at any time. You should see a Q&A widget at the bottom of your screen. So click that button and please send us questions at any time. If we don't get to your question today in the webinar, we'll certainly follow up either by email or by phone call to address those. So some background on my guests. Timberlane Partners is a real estate investment firm specializing in multifamily housing, serving family offices and ultra high net worth individuals with an institutional approach to investment management. Based in Seattle, the firm manages in excess of $1 billion in real estate assets in select West and Mountain West markets in the United States. Timberlane has delivered strong returns over its history and has been among the most active multifamily investors in the Pacific Northwest in 2023 and 2024. Our first guest, John Chaffetz, is co-founder and principal at Timberlane and oversees the firm's investing, underwriting, and fundraising. Prior to Timberlane, John worked for Morgan Stanley in New York City, where he primarily focused on fixed income, private equity, and commodities markets. Jon Hallgrimson, managing director, brings decades of experience to Timberlane. During his 30-year career at CBRE, John closed on roughly 1,200 transactions, comprising over 160,000 units with an aggregate value exceeding $27 billion. John is a nationally recognized leader in the multifamily industry. And we have Jake Leibsohn, partner, who oversees all aspects of Timberlane's fund vehicles, raises private and institutional equity, and leads financing efforts. Prior to Timberlane, Jake served as managing director of Northmark's Seattle-based regional office, where he originated more than $1.6 billion worth of debt and equity, including over $375 million for Timberlane Partners alone. Gentlemen, thank you for joining me. How are you?
Doing great. Thank you, Tim.
Thanks, Tim.
Terrific. So let me kick things off here. The real estate market has undergone dramatic shifts, as we know, in recent years. In 2020, we had many people who were forced to work from home, and that's evolved. That's still evolving. Many people continue, though, to work from home or in a hybrid working environment. And another factor that's impacted the real estate market is interest rates that plunged in 2020 into 2021 as the average 30-year mortgage dipped below 2.7%. Today, the average 30-year mortgage is roughly 6.4%. That's an average figure. That's moved down from 7.8% rates we saw last October, but still over double of where we were just a few years ago. So these are two major factors that have reshaped the landscape across all real estate subsectors. And the headlines we are and have been seeing are buzzing with stories that might make investors pause. Let me offer a few headlines from the Wall Street Journal in recent weeks. We have San Francisco is sinking in bad hotel debt. Another, housing starts slide to 4-year low as mortgage rates bite. 8.5% of US homes have an estimated value of $1 million or more, a record high. One more, lender portfolios of foreclosed and seized office buildings, apartments, and other commercial property grew 13% in the second quarter. So in addition to the headlines, we're seeing pretty much on a regular basis reports of major investment houses who, through the funds that they manage, are foreclosing or on properties or otherwise selling properties to raise cash for exiting investors. So quite a bit of activity, movement, even dislocation in certain property categories. So you folks focus on multifamily properties. It would be terrific if you could give us a high-level overview and level set where we stand today in the multifamily market and perhaps touch on some other areas of the real estate markets, such as office.
That sounds great. And thanks, Tim, for the intro. And thanks, everybody, for joining. Like Tim said, my name's John Chaffetz. I'm one of the co-founders of the firm. And I appreciate the nature of the first question, because as you can imagine, we get emails from investors, potential investors, colleagues all the time saying, hey, how are you doing? Real estate is in the gutter, or real estate interest rates, this must be terrible for your business. And what we learned through those interactions is that in general, people tend to generalize across all of the real estate sectors, and each of those sectors on its own is actually a unique and fairly large sector of the economy: office, retail, multifamily, maybe industrial being the biggest four. You also have hospitality and obviously other more kind of niche sectors. And I think the news that dominates is really the story of office, which isn't what we're going to talk about today for the most part, but it's important to understand. Obviously, office has gone through a big sort of fundamental change where no one really knows exactly how much office is needed, how many days people go into the office, et cetera. And all that stuff makes it very difficult to be an office investor, and which we understand and we sympathize with. But multifamily, that's a great way to draw a comparison with multifamily, which is actually a fundamental societal need. It's a physical thing that everybody needs. Everybody needs to have a pillow at the end of the night, right? And so multifamily tends to be far more stable. And you saw that in the GFC, you saw it in COVID. That doesn't mean that valuations don't move around. Of course they do. But the actual fundamental use of the asset and need for the asset is more predictable. And so that is one of the reasons. It's not the only thing that we do, but it's the primary thing we do. And it's one of the reasons we focus on it, is because it's a very solid, predictable type of investment product that suits our clients well. I would also say that, there are some aspects to all real estate that are affected by the interest rate dynamic that you brought up that are at play in all of the sectors, even though there's some differences, which is that volatility in interest rates, it doesn't mean you can't make great investments, but it does make it harder, and it definitely causes liquidity to slow down. Right. So there's fewer institutional players able to transact when they don't know what their cost of financing is. So that creates opportunities if you're a private source of capital like us. It also puts the brakes on development, which is true in all the asset classes right now: office, retail, multifamily. Development comes to a halt when there's too much volatility in interest rates, in particular if interest rates are rising. And so one of the things unique to multifamily is that we have kind of a perfect storm where we know that the need for multifamily will persist and grow over time. We also know that the amount of multifamily getting built is coming to a screeching halt. We also build as well. We haven't, that part of our business it will exist, but I can tell you that there's no shovels going in the ground today or yesterday or the month or quarters before that, right? And that's true for many other builders. What that means is 25, 26, 27, we expect there to be a pretty sharp shortage with respect to multifamily properties, especially in markets that are growing, right? So you add that growth plus unit shortage, you would expect to have an asset class that performs well, even though today in many markets, some coastal markets have started to emerge from this, but you see it in the Sun Belt. Most of the headlines you read about multifamily talk about how much supply there is, which really is the tail end of the effect of that 2020 drop in interest rates that you saw. So there was a golden period of basically free construction money, and everybody started building. And so today it's just a very confusing picture. We feel very strongly 25, 6, 7, the demand for multifamily is there. Today, what you see is, hey, there's too many units getting developed, but actually that business, there's a big lag. And so we expect once the markets finish choking down all the buildings that are getting put up, you're not going to see that type of construction for many years to follow. So I think that kind of touches on the fundamental kind of way we view multifamily relative to the other sectors. One of the most dominant factors in how all this fits together is the financing market. Jake, my colleague, is, like you said, is a recovering capital markets broker, debt broker. Really an expert in financing, sources of financing, the dynamics in the lending market. So I'll let him talk for a couple minutes just about that.
Yeah, Tim, you hit on it in the beginning, talking about how impactful financing has been and the rise in interest rates has been on the overall real estate market. I think something that's very unique with multifamily is that there are government-sponsored entities, Fannie Mae and Freddie Mac, that are really the backstop for financing in the multifamily sector. That's something that other sectors don't have. Office, retail, industrial, they're very heavily reliant on the banking system. They're also very heavily reliant on life insurance companies. And so there's been a pullback in the credit space, primarily in those sectors, and much less so in the multifamily space because of the backstop that we have with the agencies. So that's one really key component. I'd say another really big factor in what we've seen as far as which assets and which sponsors are having challenges in these markets is The sponsors that finance their assets with floating rate debt are the ones that are having the most challenges in today's market. They borrowed debt that has a spread over the short-term rate, SOFR. And as SOFR went through the roof, the cost of borrowing went through the roof. And that's where the challenge really seeing sponsors that put on fixed rate long-term financing, even if they acquired an asset and the asset has come down in value, they're not really having too many challenges. But if a sponsor acquired an asset with floating rate debt, they're starting to run into some issues where, the yield on the overall asset is not covering the debt service that they need to pay. And so they're working with their lenders to try to get extensions and loan modifications. And we're actually seeing a lot of that being done. Lenders don't want to own assets. They want to continue to let the operator that hopefully knows what they're doing continue to do what they do. And so we haven't seen as many properties being taken back, but we're definitely seeing signs of people having issues and needing to sell assets at big losses. And that's where we've been taking advantage of it.
Quick question.
Yeah, go ahead, Tim.
Regarding the Fannie and Freddie financing, is there anything out there that could put that at risk, either politically or otherwise, or is that something that's pretty much in place and a given?
That's a great question. I think it's really the government wants the liquidity for multifamily as a backstop in every market. There's a huge issue that would come to the overall market if that liquidity wasn't there. It's really fundamental in keeping housing where it is today, because it's like John said, it's a fundamental need. So really, we don't see that as a risk in the market that Fannie or Freddie would ever not be there as a backstop to provide liquidity to owners of multifamily.
Good. So I interrupted you. I think you were going towards people that were trying to refinance. Maybe some can't refinance. I'll let you finish your thought, but if you could segue into who's selling properties right now, what circumstances are they dealing with that you're able to come in and scoop up?
Yeah, that's a great question. And there's no better expert out there on the type of sellers that are out there in the market than Jon Hallgrimson, who came over from, as you mentioned, Tim, in the beginning, an investment sales background where a majority of his clients were institutional groups with open-ended core funds. So I'll let John answer that question and maybe give a little background of why he made the transition over to the principal side of the business.
Yeah, I was at CB for 36 years, led a team of institutional investment sales brokers with $27 billion in sales total. We led the West Coast teams, and so I got a really good perspective on all the different West Coast markets. And I've been through a lot of the crashes. The first one I went through was, the S&L crash, and then it wasn't too bad, the .com, 9/11, first Iraq War, and then the last one, the GFC. And if you looked at the investors that were able to have the courage and the conviction to buy in those down cycles, the amount of wealth creation was so much. It really was in those combined cycles coming out of the recovery, like 2009, 10, 11, 12, what was acquired then far exceeded the rest of the 36 years, just those periods in time. And so I was waiting to make the transition from the brokerage side over to the principal side. I've been an LP investor myself in over 100 of these. I'm in multifamily investments. I'm at CBRE. All of our office brokers they don't invest in office, they don't invest in retail, they don't invest in industrial, they all invest in multifamily for a lot of good reasons. But when this happens, who comes in really to be able to acquire these assets are the high net worth. The institutions right now, for a variety of reasons, have redemption queues that they're having to deal with. They've got an office portfolio that's causing all kinds of problems for them that they have to deal with on a daily basis. And so what it's causing them to do is that they're forced to sell at the wrong time. So the wrong time, the wrong side, because we talked quite a bit. I'll turn it back over to Tim or anybody else who would like to add anything.
Just in terms of you mentioned that some of the institutions are having to fund liquidations and redemptions to clients. I'll just note for our audience, you do have today vehicles out there where they offer their investors quarterly liquidity that's predicated under certain terms, and you'll have illiquid assets in a pool, in a structure that offers those types of redemption terms. So that's one of the areas where they're having to raise capital because clients are asking for their money back and they're hitting up to certain levels. So just in terms of that segment of the opportunity set for you folks, is that still an ongoing thing? I know it's been in the news since last year. Is that continuing, and how long do you think that continues?
Yeah, I mean, what I would say is that it's funny because even during the time that this webinar was conceived of, we kind of shifted from interest rates rising to interest rates starting to decline. And it pertains to some of the questions we thought about in advance is how do you think about that? And I think that obviously, there's a narrative that has some truth to it that when interest rates are going up, it's trickier to buy real estate, although it also creates a lot of opportunities because there's fewer buyers. And when they're going down, in theory, it's easier. But there's a sub-narrative that I think is very powerful with respect to big institutional groups, which is that when there's interest rate volatility, that's really challenging. Even if the average rate is staying the same over 6 months, if it's plus minus 30 basis points, 50 basis points all the time, which is kind of the world we've been in, where interest rate traders are hanging on every word at the Fed, it makes it very difficult for big institutional groups to have a party line of what their cost of financing is. And those groups are very bureaucratic, administrative. They don't react well to a 15 basis point movement, that their investment committee approved at some other level. And so what we've seen is, last year was really characterized by a lack of liquidity where we didn't see a single in all the things we were trying to. Last year was our busiest year of acquisitions ever. We were not competing with any institutional groups. We were competing with a small handful of other groups like ours and high net worth individuals or big family offices like Jon Hallgrimson mentioned, who can buy things on a discretionary basis. Now that the interest rate cycle is, I don't want to say it's coming back down. We have a view that there's some structural resistance to that, but now that it's at least not obviously rising and probably holding steady or coming off a little bit, especially on the longer dated instruments like treasuries that affect real estate, for sure we feel a little bit more liquidity coming back, right? There's no question. But it has a long ways to go to get back to what a normal capital markets dynamic feels like. I don't want to make random anecdotes, but I remember we bid on an asset a couple months ago where the bid sheet had three or four people on it. Whereas, John told us that back at CBRE 2 years prior, the same asset had like over 100 people bidding on that. And so I think the opportunity for private investors is to get into assets that are institutional in quality before the institutions make the big light switch flip and say, you know what, we're buyers again. Because when they do, they all have cash, right? It's different than other downturns where it's like a no cash crisis. Here, most of the people who buy real estate, Blackstone, Starwood, all these big institutional groups, pensions, they have the cash. They're just not sure what to do with it until things settle down. So we expect one of our core theses, and I would recommend it to clients of your firm is it's great to buy institutional assets when there are no institutions around, because there's so many of them. They tend to move in a herd. So when they come back in, they're going to all come back in. And I'm hoping that the choppiness that we see, and I expect this to be the case, persists enough to give us another 12, 18 months of the current dynamic that we see, because it's a phenomenal buying opportunity.
And Tim, as you mentioned, there have been significant redemption queues. Those are starting to go down. There are people that are either no longer in the queue. They've decided to stay invested in the fund. There's also been liquidity that's been produced by those open-ended funds through selling some assets. And we've really taken advantage of that. So last year, we acquired 80% of our assets from institutional open-ended core funds. And so we saw that as an opportunity, that they were looking for liquidity. The easiest place for them to find liquidity within their funds was through the multifamily assets. And we knew that they were sellers. We knew they were unemotional when they were selling. They weren't thinking about what they bought the asset for. They were just looking for what they marked it as most recently. And so we took advantage of that, and we acquired many assets from those groups.
So in that sense, how important is it to be ready to write a check, if you're up against others that can do it quickly and just knowledge of the market,
Yeah.
Versus sort of, the idea that you sort of need to be focused and knowledgeable of a particular region versus maybe a generalist that could just write a check from New York City or somewhere else.
Are you, I just want to make sure I understand the question. Are you saying, how do you compete as an investor in a dynamic like the one we're describing?
Yeah, I think I asked two questions, so good point. So it's about competition with some of the institutional folks, and the second part B of the question is sort of like, how important is it to be in the market versus sort of on the other end of the continent writing a check?
Yeah, I mean, so I'll answer maybe the second question first, which is that, and I'll answer it from the perspective of what our firm is, which I would describe as and I'm saying this with all humility, I'm knocking on wood here, but like a somewhat regionally dominant firm, right? I'm not trying to make grandiose claims, but we're among the most active groups in the Northwest, actually the most active in Seattle in the last 12 months. And an important player in some of the other Mountain West markets too. So what we see is that, and I'm sure this exists in every market, right? I'm sure this exists in the Southeast. I'm sure this exists in the Northeast. I know it does, right? That there are very active groups like ours who look at every single deal in their market above a certain size. So we don't look at deals under $20 million, let's say, but every deal that comes over that, we know about it very early in the process. This is not me selling our services. It's just me explaining to you what I'm saying, which is that groups like ours see deals very, very early, can form a house view very, very early, and can also wait until relatively late in the process to decide which ones we want to get aggressive on. And as long as you have liquidity, which, like a firm like ours has liquidity via a blind pool fund, we can get very aggressive very quickly on assets that we want to buy, frankly, much quicker than an institution can, right? Because institutions are not characterized by speed, right? Obviously, they have lots of money, cheaper cost of capital in theory, but definitely bureaucratic and slow. Also, Jake mentioned how they can be very unemotional. A lot of institutions have no problem retrading. It's less of a relationship business for the institutional buyers. So whereas for us, there's intimate relationships with all the brokers that you need to know. And many times the actual sellers are friends or not. John brings like decades of experience with the sellers of the markets we're in. So I think whatever market your investors are interested in, I'm a big proponent in finding whatever you want to call it, sharpshooters, regional players. The returns they generate almost by definition should be better than like a giant, like a huge national firm, which really is just buying the market. If you have to put out, billions of dollars a year, I just don't believe that they always say they get the best deals, but that's impossible, right? If you're buying billions and billions of deals, you're buying every deal you can buy, basically.
Yeah.
Right. Whereas we're trying to be selective. We're trying to look at every single deal, but choose the ones that make the most sense. If I were investing in Florida, I would find someone with a similar philosophy myself. I don't, if you're, and then there's the second part of your question, like investing from afar. If I'm responding that differently than what you intended, just tell me. But we are an unusual firm because I'm from New York. Almost all of our capital comes from the East Coast, not all of it, but a huge majority. And yet we invest, predominantly, right, in the Mountain West and Northwest, Washington State, Utah being the two big ones. And so for us, I view regional strategies as a good hedge for whatever. I mean, it's worked out nicely for us where our clients typically own a bunch of real estate on a personal basis on the East Coast, Florida, New York in particular, and having exposure to different markets, in particular, kind of like West Coast tech driven markets is a different source of growth for them. There's obviously nuances about which markets you pick, which I'm sure you'll ask questions about. So I think it's more important to find regional experts than it is to fixate on investing in your own home market or something, for example. In fact, we have a lot of investors who first tried to buy apartments on their own, like down the street from where they live. That's the best client we have because they realized that was a terrible idea usually.
So continuing on that theme then, just in terms of your areas of operation on the West Coast, so as a New Yorker, maybe I might be thinking that the West Coast is this big monolithic zone. So tell me what opportunities and the differences of the different regions and states on the West Coast.
We get that's a topic that comes up for us all the time. Like, is it good to invest in the West Coast? If you're on the East Coast, if I make the same analogy, you'd quickly say like, well, okay, but Boston and New York and DC and Miami are not at all the same, right? So our view, and again, I want to be careful about how we portray ourselves. I view ourselves as more like Western US in the sense that we really are very, very active in Utah and Colorado also. But not just the coastal markets, but so we have chosen a handful of markets that we think fit well together from a diversification standpoint. But directly to your question, and maybe I'll just answer it if you don't mind in the very direct way, like why do we like Washington out of the West Coast states? So the fundamental thought, right, is, and a lot of our investors have this view, is that whatever you want to say about some of the challenges that the West Coast has, it's obviously still a massive economic engine. We don't expect that to change. AI is a whole nother wave of economic growth, job growth, all of that. So it's good to have exposure to markets that are dominated by that story. That said, not all the markets are behaving the same way. San Francisco and Portland, really got dealt a semi-existential blow by COVID. We don't touch Oregon for that reason, basically. And San Francisco, I suspect, will slowly recover, but at what pace and to what degree is anybody's guess. And San Francisco has a challenge because it has a major job center that's not in San Francisco that has to compete with. So there's probably really good arguments to be made to invest in San Jose and South Bay and South Peninsula and all that stuff. That's not the market. That's not a market that we're actively in. But my point is that there's a lot of turbulence in the Bay Area from the COVID blow that it took. And LA has generally been a very well-performing market with a lot of economic drivers, but the housing stock in LA is dominated by small, diffuse, rent-controlled product, right? So even if you love the story, there's not a lot of product that fits the quality that we're comfortable with. So, and we've done this before, so we know this intimately well. We're not really in this space anymore, but in LA, you're buying 15-unit buildings built in the 20s that are rent control, that are reinforced masonry, and it's a very, very sub-institutional space. A lot, like a huge majority of the assets, and then there's big towers and fancy stuff downtown. Not a big fan of downtown LA for an investment market. It's kind of like office, like fortunes will be made, fortunes will be lost. That's not really the type of investor that we seek. We want somebody who's looking to hit reliable singles and doubles, and that's our philosophy. So all of that being said, Washington for us presents a much more kind of rational alternative. It is one of, if not the main AI job state, with Microsoft and Amazon there. There's no income tax. There's just a lot of macro favorable things happening. And it has some of the same West Coast challenges that lots of cities has, but to a significantly less degree than all the other big cities, let's say. So for us, it's worked really, really well. And again, in particular, and again, if we're talking about another firm, not just ours, I like the idea of someone who's a specialist in a couple of markets, because then you can match things up in a way that provides a logical logical hedge to each other, right? So Utah is like a more business friendly, rational, like younger, quicker growing state. Washington's more established, but has some really like very high horsepower employment stories there. So we like how those fit together. I think it's important not to get tunnel vision and say like, I only invest in Fort Lauderdale or something, because then how do you know what's happening in other places? So you have to have enough strategies to perceive relative value. So
you mentioned AI, and I know you mentioned it in the context of job opportunities and the major companies like Amazon competing in that space. So I'm going to ask it because AI has to be asked for every
Sure.
webinar. But just in general, technology, innovation, how relevant is that in your industry?
Yeah. So taking out the like, does it create demand does it create more high paid renters in our markets as a job center? I think I've sort of alluded to that. So we'll move past that. Yes and no. I mean, the housing business, the real estate business is a physical business. So there's a limit to how much it can be disrupted in terms of what the customer gets, the renter, but in terms of how we organize ourselves and how we, evaluate investments and things like that, for sure, there's technology coming into that space. And I'll actually let Jake, who's closer to the action in that front, describe what we see.
Yeah, no, it's a question we get asked a lot, how we're using AI as a firm to make better investment decisions, and something we think about a lot. And I think it's still really early on in the overall use of AI, especially in an old school industry like real estate. But that being said, there are tools and new technology that's coming out that's helping us substantially. One of the harder things to do as an investor in real estate is to really understand what's happening within a market when it comes to rents. And there's AI softwares that are really getting better and better at understanding what each unit is being leased at by kind of scanning the entire web, knowing when there's a listing for a rental unit and when it's being taken down. And so by seeing that, the AI can really predict what the rent was that they were able to achieve on that property. And so having better insight into what rents are being achieved at our properties is very easy, but at other properties it's harder. And so this technology is helping there, and I think there's going to be continued improvement in the technology space to help us be better investors. I mean, going back to when John first started in the business, I'm sure rent rolls were all handwritten. I always get a kick out of what the world used to look like and what it looks like today, but it really does make investing a lot easier in some respects because we have so much more information and can predict kind of what we think is going to happen as far as trends go. Going off of that, onto a slightly different topic, but with all the information that we see out there, we're also able to predict what's going to happen in the supply story. And that's such an important thing. I know John Chaffetz mentioned that early in this conversation, but as we look out into the future, we know how many shovels are being put into the ground for new multifamily developments. And it's really completely fallen off a cliff. And so we know what the supply story is going to look like in 3 years. And we know what it's going to look like next year, and we know what it's going to look like in 2 years. And by looking at that, we can really predict, where we're going to see the most growth in rents. And so that's something else that we're very focused on. John, you want to add anything about what the world used to look like when you were looking at rent rolls in the beginning of your career?
When I first started, we didn't even have Excel. So when we did evaluation, if you changed, the rents by 10 cents, you had to redo the whole thing by hand. So that's what it was like back in 1987. So it blows me away what we can do here, and it's amazing. As the brokers, our team embraced a lot of it that really levered us up to be able to do volume that I never would have expected when I started.
I think just to add one point on this, Tim, so Jake alluded, like there is a proliferation of very specific AI tools that we use and bigger players use to get really smart on rent trends and construction trends and costs. We can talk about the specific tools if you're interested in it, but that's a whole deep dive. What I think it speaks to more broadly, though, is that it's harder to be an amateur landlord, right? Because there is greater and greater sophistication and technology used by groups like ours and used by other, big property managers that create an advantage against anybody who doesn't have those tools. And there's kind of an economies of scale game that happens, right? If you have a building with 20 units, you don't have that much data to work off of. If you have several thousand units or 20,000 units or 50,000 units, like some of the big managers that we also work with, AI tools start to become very dangerous in a good way. And even incremental insight about where rents are headed, or what Jake was alluding to is generally it's hard to tell what people are asking for because they put websites, they put an asking rent on a website, but there's no way to know what they actually signed the lease for. AI helps to clarify that by looking at where things are happening over time. It's very clever. I mean, it works. It's a very powerful tool, but it relies on a lot of data to be smart. So that that relies on scale.
You answered my next question, which is why shouldn't a wealthy investor just go out and buy their own apartment building?
I have a couple. I can send you a list of some specific people you can call and ask how it went for them when they did that. You're not even going to get to the AI part. You're going to get to toilets clogging at 1 a.m. They have to go deal with it themselves. But yeah, I think even John's been in the business for a long time. I've been in the business for 15 years, and Dave somewhere in the middle. Even during I'm the shortest tenure of the three. Dave, my business partner, is not on the call. Even in my time, I've seen the significant increase in sophistication of management practices, quality of leasing practices, leasing agents, technology, website quality, and so renters are faced with very professionally marketed units. Right. And if you're not able to compete with that, you will be selling a less well-positioned product, no matter how good the physical asset is. Right. You have to get somebody to show up and look at it. And we see that difference. Like when we're buying assets, we're looking for assets it's hard because of the scale that we're operating at, but you'd be surprised. You still find a large, institutional quality assets. Oftentimes it'll be operated by a REIT or something where they're so focused on cash flow that they're under investing in technology and leasing quality and kind of the whole package. So for us, we see operational upside when we buy from them. But yeah, it's hard as an individual. Unless you want to make it your full-time job, that's the other thing, right? I mean, if someone all they want to do is buy and flip a 20-unit building, like for sure you can do well at that. But people always underestimate how much work it is. They think they can do it on the side first.
So earlier you talked about how rates have come down. There's a little bit of liquidity back in the market. Analogous to that is what if we have a recession? The economic numbers have come in mixed. Sometimes they're a little hot. Sometimes they've come in cold. Some prominent people that we follow think that we might be headed to a recession. That's not our baseline, but that's out there. So what would you say if we were to have a recession next year, the impact on the multifamily market, and maybe if you could give me some sense of what the impact might be in other markets?
Yeah. So we say this, we try to remind ourselves of this all the time because we sort of feel more strengthening, which is surprising to us, than weakening. And the immediate thing we look at, people are excited to see interest rates potentially come down, et cetera. So it feels kind of like a bullish time if you're multifamily, but we try to remind ourselves internally, and we remind our investors all the time, hey, listen, the government has had their hand has pulled the emergency brake on the economy for a long time. Like you would expect it to slow things down. It's sort of surprising that it hasn't. It does feel like we're starting to see some signs of that you allude to. And I think it's generally smart to have a defensive point of view. If you can find a way to make money while still being defensive, it's better than taking a bunch of unnecessary risks, the way we look at it. So that's kind of why we focus on multifamily in the first place. If you look back to the GFC, the last time there was a significant, recession, probably a different type of recession than the one we might see today, but a significant recession nonetheless. It's interesting because that was the valuations of assets move around a lot, but multifamily, the actual occupancy and performance of the assets during the GFC was relatively stable, right? So I don't have the exact percentage points in front of me, but I recall from a previous little paper we did that in Seattle, the peak vacancy for multifamily occurred before the GFC, when everybody was getting free money to buy their houses and renting less. And there was kind of an actual elevated vacancy moment. Then the GFC hit and everybody's starts to rent, right? And so it's not a time that you experience tremendous rent growth per se, but occupancy can be fairly high because people are choosing to rent. People can't afford to buy a house. People can't afford to buy a house in general is declining affordability with interest rates and all that other stuff. So I think we have a graph on that shows the difference in cost between rental and purchasing. That gap is kind of at or near an all-time high. right? We don't, like in a recession, that doesn't really change. People just have less money. So it's just, they're more sensitive. They're more price sensitive in a recession. So I think that the way you have to, the way I'd answer the question is kind of like, you make money in our strategy largely on the buy, right? Like the better your basis with some term, the better likelihood you are that you're going to deliver a great result over 5, 7 years, 5, 6, 7 years. So if a recession causes the continued, like the choppiness that we've already been talking about, right? Institutional money on the sidelines, less development. From our perspective, if a recession causes that challenging period for a lot of people to continue, it probably extends the buying opportunity, right? From our perspective, it probably makes, values will stay low, will not recover as quickly. That means that all the debt maturity issues that are in the market will continue to persist. So it kind of depends on your point of view. I think that we basically are modeling everything that we buy, and not exactly the same way, but with an assumption that the next year or two are likely to have zero or very flat rent growth. Like we don't see the next year or two being a big source of explosive rent growth. We think that's coming later, like 26, 7, 8, where the supply drop off happens. So I think as long as you can focus on assets where even if you're kind of underwriting the next year or two, like a recession, or let's just say a weaker period as possible, and you still get to an acceptable return, like that would be the philosophy that we espouse, as opposed to saying, okay, interest rates are coming back down, everything is hunky dory, let's just go guns blazing. If there then were a recession, you might have some, you might have a problem, right? So we're proceeding enthusiastically but cautiously, and looking at markets where we think even a recession is going to be, it'll be impactful, but let's say less so.
So
and just to point out the slide that John mentioned, there's a significant delta between what it costs for being a homeowner versus what it costs to rent, and so that's really what's a factor in driving demand, and we expect that demand driver on the renting side to continue. And then as supply drops off, that's going to have an imbalance of the supply and demand in the housing space. And that's what gets us really excited about rent growth. And as John mentioned, not necessarily in the near term, but in the medium and long term.
So then I'll offer up this softball just in the multifamily space. Is it a good time, an average time, a time to be cautious? What's your thoughts?
I mean, look, it's a softball question, which is always nice, but we can't answer that completely neutrally because it's the business that we're in. But what I would say, just anecdotally, is that we raised our blind pool fund last year. We did that directly in response to this moment. So we obviously think it's a great time to invest. That's why John H on the call here, left brokerage to come to the buy side. So we're sort of putting our money where our mouth is and doing it. I think it's a phenomenal time, with a major caveat, right? Which is that anybody who comes to you, I would say this in real estate in general, and says we're going to make a bunch of money over a 2-year period, and set that kind of short-term bullish expectation. I think that's the thing that I wouldn't say, right? Because of the recession comment that you made. We don't know. We really do believe I don't want to say, I mean, as strong conviction as we have that values will rise on the assets we're buying over the next handful of years because of the fundamental demand for the product and the shortage of supply that's coming. But we don't know if that's 18 months or 12 months or 24 months. So what I would say is I think it's a phenomenal time, provided that you have what I would describe as a more mature understanding of how real estate markets usually work, which is like 5, 6, 7 years. People kind of got high on the hog before interest rates started rising. There's lots of investors that we encounter who say, well, I made 20% over 18 months, right? Because there was like this extreme increase in value very quickly. And that's what they're used to. They think buying a multifamily building or any office building or anything is like a 2-year strategy. And if you're having a 2-year strategy, you could be really right or you could be really wrong. In that context, I think it's much harder to be super excited about any sector today. But But for a group like ours that's really focused on, let's say, 5+ year holds, where some of the more fundamental macro data like supply and demand really is what drives things, we couldn't be more excited.
So I'm going to ask for questions to come in, Ellen, if you want to feed those in. So I'll while that's getting sorted, I'll maybe just ask a question. I don't know if it's a quick answer question, but it's something that I've been thinking about as a New York resident. You know, what's the link between office and multifamily? I would think that there'd be some linkage, you know, just from a long-term perspective. In New York, obviously, we have the issues with commercial property and in the office, I should say, with strength in the multifamily. So how does that normally work? And why is New York, you know, hot and cold at the same time?
I think John probably offers some interesting perspectives on this question, but I'll give you my 2 cents and then pass it to John. The other John, I guess, is that they are linked, especially in urban core environments where what is happening it almost matters more, like what the value of the office buildings is doing is less relevant than what is the practices of the employers, right? So for example, in our markets, there's a very strong return to work mandate in downtown Seattle office. That's very beneficial for the overall picture in that city. There are pockets in Seattle that have like north of 90% office occupancy and others that don't. So the office narrative is extremely localized. On average, on a national scale, office has taken an absolute bath. And on a valuation basis, basically everywhere it has. But just some office markets are still functioning and healthy. So I would say that what we pay attention to is there employment growth in these submarkets? So like Utah is totally different, right? Utah has a lot of big office tenants going in sort of secondary locations, right? Like a big Adobe campus or something. If that happens, that's like new office growth is very galvanizing for those types of locations for residential, because there's no residential product designed for that type of worker around there. So it triggers a lot of growth. If you're talking about infill office, we're more focused on like what I just mentioned, kind of, hey, is there a strong enough employment market in this office market to rejuvenate the downtown post-COVID kind of a thing? I don't know, John, if you want to add to that.
Yeah, I'll add 2 things. One, I would say that when an investor would come into Seattle, we'd sit down for the first time. Sounds a little odd, but we would immediately pivot to the story with our office market and what was going on with Microsoft on the east side, with Google and Amazon downtown. And those are the economic drivers. And Seattle has had more office product delivered than any other market in the United States over the course of the last 12 months, which is kind of surprising. But those tech companies are continuing to grow and continue to expand. The second thing that I think is important as you hear about office, B and C office, you know, a lot of the municipalities are looking at their tax revenues, and that's a good source to be able to provide some incentives. It's extremely expensive.
Oh, John's coming in a little choppy for me.
To convert Class B and Class A. Maybe, I read about this, is there going to be some supply that kind of sneaks out of nowhere, and the cost to do that is so prohibitive that we haven't really seen. I know in New York there's a few specific cases, but the building has to really be conducive to that, and it has to be a very, very core AAA location.
I mean, yeah, that's a good point that you bring up, just about converting properties. I mean, it seems to me that there would have to be some almost government program to sponsor that, to get it going. Any thoughts on that?
That's a question that that hasn't exactly been asked, but it's one we get a lot, which is, hey, do you think that there's going to be a big surge of supply in multifamily because offices are going to get converted, right? It's kind of a question that comes up a lot. And I actually think that whether there's a government program or not, that no amount of subsidies could make up for some structural reasons, practical reasons why that's very difficult in any kind of significant scale, which is that office plates or office floor plates are just not conducive to put housing. They just aren't, right? I mean, you you have big single floor with a central elevator corridor. There's not enough windows. It's very, very difficult. It's extremely expensive. A lot of people we know who are in that space end up concluding it'd be better to just tear down the building, right? And so, sure, if there was like government subsidized demo and environmental liability cleanup, because a lot of these buildings have asbestos, they have all kinds of stuff that makes it very difficult to actually economically repurpose. It doesn't mean it does happen, but it's a little bit more of a unicorn. So I think office might have some easier paths to conversion in some other sectors like hospitality. I've heard of more projects going well in that situation, although honestly, I hear more hospitality just getting converted to multifamily because that is much easier to do. Yeah, the office question is tricky. I think you asked how can New York be hot and cold. There's definitely a theme that the best offices are in short supply, and those types of employers are absolutely out looking for space and those types of buildings. But it just means that B+ and below office, the demand for that is sharply down. And New York has both of those things, right? I mean, like there's office for Goldman Sachs and American Express, and then there's office for law firms that don't necessarily need to be in an office anymore. That type of conundrum, I don't know how that gets solved, honestly.
Yeah,
it's almost like
one thing to add on there, and we talked about supply completely fall off the cliff, and I think that we didn't really talk about why that is. I think the big reason is that the cost of building a new multifamily project today is so expensive. We're actually buying new multifamily assets for about 30% below what it costs to rebuild them today. And so if you take that statistic and then you realize that you're actually going to have to pay anything for land or anything for an office building to convert it, it makes it really impossible to make the numbers work in today's market to convert an office building into multifamily. Same with just even putting in a shovel in the ground and building a multifamily project on a vacant land site. It's just really hard to do today.
What's traditionally the spread, Jake? It's 30% more expensive to rebuild today. What in a normal market, or at least 10 years ago, if you can come up with a spitball?
Well, yeah, I mean, you really in most scenarios you want to be able to build a brand new asset for less than what it costs you to buy a brand new asset that's already stabilized. And so until we see that that spread change to where it's now positive to actually go build and then sell the asset, we're not expecting a big amount of supply to enter the market.
Tim, to answer that question, like slightly, I mean, developers tend to be optimists, and so they're it's like you once they can sell things for at least what it cost them to build it, then they tend to think that by the time the project's done, the rent story will have grown and it'll probably end up being worth more than they paid to build it. But that's the dominant dynamic most of the time, but it's certainly not the case today.
I'll add one thing too: is the developers, all the capital is institutional, the equity, and the equity requirements are 40% of the cost. So there is real equity. That's a big difference between the GFC and today. And they're caught with the same conundrum that we're not buying, they're selling, and they're not funding new construction. So it's all really jammed up.
So the properties that you're buying, and in some cases, repurposing to some extent, I'm interested to know, like, what amenities need to be there today that maybe 10 years ago would never have been there?
There definitely is an amenities arms race. I think some of it, is a little bit foolish, meaning some of it I think has real appeal. Like, I think if we bought a building in Denver, or we looked at a building in Denver, we didn't end up buying this one that had an incredible, pool amenity, for example, on the roof. It's really not that hard to imagine. If I said, Tim, do you want to live at a place with an incredible pool? You'd probably say yes, right? If I tell you that it has a climbing gym in the wall, unless you're a huge climber and I didn't know about that, that's probably less relevant to you, right? So I think some of that is almost to justify the cost. It's almost like, oh my God, we're spending so much money in a time over the last 10 years, construction costs have risen a lot. Fundamental construction costs have risen a lot, not because you're putting in a climbing gym, right? The cost of actual labor and concrete and steel and wood is much higher. So, and I doubt that will change, right? And so people kind of say, well, if I'm spending $500,000 a unit to build this instead of $300,000 a unit, I better spend 520 and make sure that it's tricked out, right? Because it makes it look more appropriate as an investment. So I think we're very sensitive to getting suckered into the amenities arms race and thinking that if you have a golf simulator, like you've solved all your problems. I think that's a little bit of a fool's errand. That said, some amenity packages are absolutely critical, and it depends a little bit on the market. But like if you're in a market, for example, like downtown or South Lake Union in Seattle, where we bought an asset in our fund, there are very highly compensated younger people in that market, where some of those amenities mean more to them. Probably a gym is critical, if you have a gym that really they can use, that's meaningful, right? If you have smart technology, right? Apps for doors, keys, like, keyless entry, all that kind of stuff. That means that does feel relevant to me. But I think there's a limit. I mean, we could go on and on with all the crazy things that people build, but I don't know if that gets to your question.
Thank you.
We are actually seeing the use of shared co-working office spaces within multifamily buildings being used much more so than they were previously. Especially on the days that employee might not be going to the office, like on a Monday or a Friday. Those are getting used, and so that is an amenity that we're seeing most developers include and definitely starting to make standard in new developments.
Besides the regions that you folks cover, do you have either your eyes set on other areas, or is there anything that intrigues you where if you can see yourself a couple of years down the road focusing on them?
Yeah, that's a great question. First, I'll put some guardrails on it and say that anytime you go to a new market, you have to be really disciplined about that, because there's other groups like us who are already in that market, and they're going to make it difficult for you. They're going to make you overpay. So and sometimes it's okay to overpay if you pick the right trade and the right theme. You can pay 5% more than the local guy and come out ahead. That's kind of what happened to us when we went into Salt Lake City. We started in Washington State. We went to Utah. The first couple deals, we had to really win those deals, right? But that was the right call for us. We had a macro view that turned out to be correct, and so it was worth it. So first of all, I would just say, when you're talking about what sponsors you want to work with, I think being disciplined about this question is very important, and we try to be. That said, just as an investor in the market, I think that the same thing that happened in a lot of coastal markets like Seattle, California markets, Boston, where they really got a lot of supply, got very soft, and now have started to recover, is happening at a different time cycle now in the Sun Belt. The Sun Belt got really trendy at the end of the last cycle. There's probably more development in Austin, Nashville, Miami, those kind of markets. Sometimes people call those the blue cities in a red state. Those kind of places, I think, are in for a tough run for the next little while, because they have so much supply coming, more so than what we've seen in our markets, and we know it's painful for us. And so I would expect, those people have been in extend and pretend mode for a long time. Like, hopefully interest rates come off quick enough that this all works out. I think that kind of the music is stopping there, I think, now, and you start to see articles in the paper about big rent drops in Austin. So I fundamentally like Austin. I think it has some of the same themes that other markets that we're in have, like it's super livable, has exposure to a broad variety of jobs, including some of the most exciting ones, like in the tech sector, et cetera, but not exclusively. So I love that. So that is a market we would look at, and I would look at it in other people's deals too for myself. Like, hey, if the same thing we just saw, which is that a great market gets absolutely crushed, I would be excited about that. So I think the Southeast is probably going to present some opportunities to people. I think that I really do think that kind of the Route 128 belt in Boston which has, again, some of the similar themes to markets that we're in, and is like less of a sexy investment market over the last couple of years. Therefore, it kind of has some resemblance to Seattle, for example, I think is attractive. I know we're running out of time, so I'll keep the answers short.
Yeah, I'll add one thing real briefly because we all run out
Sure.
of time. Because I've seen Seattle and Phoenix, and they always talk about the job growth and, oh, Phoenix has this unbelievable. You have to look at what the salaries are, what type of jobs are being created. And so not only is Seattle kind of, at par close to Phoenix historically, not so much in the last few years, but the type of jobs that we create are really high paying and tech driven. So I just want to add that.
Great. Gentlemen, thank you so much for your time. I'd like to thank all of our listeners today. Anyone whose question wasn't answered, or if you're watching this on replay and you have any questions, please reach out to us and we'll respond to you quickly. Jake, John, and John, thank you so much. This was terrific. I appreciate your time. And everyone have a nice day.
Our pleasure. Thanks, everybody. And thanks, Tim.
Thank you.
Yeah, thank you.